The dividend ETF universe has exploded with dozens of funds all claiming to provide the best income strategy. But here's the reality. Most dividend ETFs overlap significantly, charge unnecessary fees, or use flawed strategies that destroy long-term returns. Today we're explaining every major U.S. dividend ETF in 15 minutes so you understand exactly which ones work, which ones don't, and which strategy fits your income goals. This isn't just a list of dividend ETFs. This is a comprehensive breakdown of dividend strategies, methodologies, and why certain approaches generate superior income with lower risk, while others are dividend traps disguised as income solutions. By the end, you'll know more about dividend ETFs than most financial advisors. The key to understanding dividend ETFs is recognizing they use completely different strategies. Some chase the highest yields regardless of sustainability. Others focus on dividend growth. Some screen for quality and financial strength. Others, equal weight or fundamentally weight holdings. Each approach creates dramatically different risk-return profiles. We'll categorize dividend ETFs by strategy: high dividend yield funds, dividend growth and appreciation funds, dividend aristocrats, quality dividend screens, equal weight dividend approaches, and specialized dividend strategies. Understanding these categories helps you choose the right fund for your specific income needs and risk tolerance. The first category is high dividend yield ETFs that chase the highest current yields available in the market. These funds prioritize income now over growth or safety. The leader here is VYM, the Vanguard High Dividend Yield ETF, yielding around 3% with minimal fees. VYM holds large cap value companies with above average dividend yields. The fund owns about 400 stocks, including financials, healthcare, consumer goods, and energy companies. VYM charges just 0.06% expense ratio and holds over $70 billion in assets, making it highly liquid. The advantage of high yield funds like VYM is immediate income. You get more cash flow today from higher yields. The disadvantage is that high yields often come from slow growth or declining businesses. Companies with high yields typically have limited growth prospects, which means your income doesn't increase much over time. Another high yield option is SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF, which combines high yield with low volatility screening. SPHD yields around 4% by selecting the 75 highest yielding stocks from the S&P 500 that also have low volatility characteristics. SPHD charges 0.30% expense ratio and holds about $3 billion in assets. The low volatility screen theoretically provides downside protection during crashes. However, high yield combined with low volatility often means you're buying mature, slow growth businesses in defensive sectors. SDY is the SPDR S&P Dividend ETF focusing on dividend consistency. SDY requires companies to have increased dividends every year for at least 20 consecutive years. This screens for quality and eliminates dividend cutters, creating a more sustainable high-yield portfolio than funds that just chase yield. SDY yields around 2 to 3% and charges 0.35% expense ratio. The 20-year requirement means SDY holds only the most reliable dividend payers, reducing the risk of dividend cuts that destroy high-yield portfolios during recessions. The second category is dividend growth and appreciation funds that prioritize growing dividends over high current yield. These funds accept lower starting yields in exchange for faster dividend growth that compounds income over time. VIG, the Vanguard Dividend Appreciation ETF, is the leader here. VIG requires 10 consecutive years of dividend increases, screening for companies committed to growing shareholder returns. VIG yields around 2%, but the dividends grow significantly faster than high-yield funds. VIG charges just 0.06% expense ratio and holds about $100 billion in assets. Holdings include Microsoft, Apple, Visa, and MasterCard. These are quality growth companies with sustainable dividends that increase annually, providing both income growth and capital appreciation. The dividend growth strategy works best for long-term investors who reinvest dividends. Starting yield is lower, but after 10 to 20 years of dividend growth compounding, your yield on cost becomes substantially higher than high-yield funds that don't grow dividends. DGRO, the iShares Core Dividend Growth ETF, uses a similar strategy with 5 consecutive years of dividend growth required. DGRO yields around 2 to 3% and charges only 0.08% expense ratio, making it extremely cost-effective for dividend growth exposure. SCHD, the Schwab U.S Dividend Equity ETF, combines dividend yield with quality and growth. SCHD screens for dividend yield, dividend growth, cash flow to debt, return on equity, and dividend consistency. This multi-factor approach creates a balanced dividend portfolio. SCHD yields around 3 to 4%, higher than pure dividend growth funds, but with better quality than pure high-yield funds. SCHD charges just 0.06% expense ratio and has become extremely popular for its balanced approach to income and growth. The third category is dividend aristocrats, companies that have increased dividends for 25 consecutive years or more. These are the elite dividend payers with proven track records through multiple recessions and market cycles. NOBL, the ProShares S&P 500 Dividend Aristocrats ETF, holds only the dividend aristocrats from the S&P 500. Currently, about 65 companies qualify. NOBL yields around 2% and charges 0.35% expense ratio. The dividend aristocrat requirement is incredibly strict. Companies must have 25 years of consecutive increases, meaning they raised dividends through the dot-com crash, the 2008 financial crisis, and COVID-19. This creates an elite group of reliable dividend payers. Examples of dividend aristocrats include Coca-Cola, Johnson & Johnson, Procter & Gamble, and Walmart. These companies have proven business models, strong balance sheets, and management committed to returning cash to shareholders regardless of economic conditions. The fourth category is quality dividend funds that use multi-factor screens beyond just dividend yield or growth. These funds combine dividend metrics with quality factors like profitability, financial strength, and valuation. DGRW, the Wisdom Tree U.S Quality Dividend Growth Fund, combines dividend growth with quality metrics and weights holdings by dividend dollars paid rather than market cap. This overweights companies paying large absolute dividends. DGRW yields around 2% and charges 0.28% expense ratio. The quality screen eliminates companies with weak balance sheets or unsustainable dividends, focusing only on high-quality dividend growers. FVD, the First Trust Value Line Dividend Index Fund, uses Value Line's proprietary dividend screening, combining safety, timeliness, and financial strength. FVD yields around 2 to 3% and provides exposure to Value Line's dividend research. The fifth category is equal weight dividend approaches that weight holdings equally instead of by market cap. This reduces concentration in mega-cap stocks and increases exposure to mid-cap dividend payers. EWVD is an equal weight approach that could be used but is less common. Most dividend investors prefer market cap or quality weighting rather than equal weighting because dividend sustainability matters more than equal exposure. The sixth category is sector-specific dividend ETFs that focus dividend exposure in particular sectors. These provide targeted income from specific industries rather than broad market dividend exposure. VPU, the Vanguard Utilities ETF, focuses exclusively on utility companies, which have high dividend yields from regulated monopoly businesses. VPU yields around 3 to 4% and provides pure utility dividend exposure. Utilities are the classic dividend sector with regulated returns, monopolistic positions, and stable cash flows. The downside is that utilities are interest rate sensitive and provide limited growth, but the dividends are reliable and consistent. FIDU, the Fidelity MSCI Utilities Index ETF, provides similar utility exposure with slightly lower fees at 0.08% expense ratio. For investors wanting pure utility dividends, either VPU or FIDU works well. VNQ, the Vanguard Real Estate ETF, provides dividend income from REITs, which are required to distribute 90% of taxable income as dividends. VNQ yields around 4% from rent payments on commercial real estate, apartments, warehouses, and data centers. REITs provide higher yields than typical stocks because of the distribution requirement. The dividends fluctuate with real estate market conditions, but provide inflation protection as rents increase over time. The seventh category is international dividend ETFs that provide dividend income from companies outside the United States. International companies often have higher dividend yields than U.S. companies, especially in Europe and Asia. VYMI, the Vanguard International High Dividend Yield ETF, focuses on high dividend yields from developed international markets. VYMI yields around 4 to 5% from European, Japanese, and other developed market dividend payers. International dividend yields are higher because international companies distribute larger percentages of earnings as dividends compared to U.S. companies which prefer buybacks. However, international dividends face currency risk and often have less consistent dividend growth. Understanding these strategies prevents you from buying dividend traps that offer high yields from unsustainable businesses about to cut dividends. It also prevents overpaying for dividend funds that charge high fees for strategies you can get cheaper elsewhere. The dividend ETF market is crowded with dozens of similar funds. By understanding the core strategies, you can cut through the noise and choose the 1 or 2 dividend ETFs that actually fit your income goals without unnecessary overlap or excessive fees. Start with one core dividend ETF matching your strategy, either high yield, dividend growth, or quality. Add sector-specific dividend exposure if you want targeted income from utilities or real estate. Avoid owning multiple similar dividend ETFs that just create overlap and complexity without improving results.